Date week of August 1st of 2022. This is our 1-year anniversary edition. I believe it was August 5th of 2021. We began our market of the moment. So we've made it a year. We've been pretty consistent, Mr. Madrid.
Look at that. Look at that. Good times.
Good times. Well, let's get into what everybody wants to hear about, what the mortgage rates are doing. We're going to talk today a little bit about all the news of a impending housing crash and a flood of foreclosures.
Oh gosh, can't wait.
Got to have a conversation about it at a baby shower, which I don't know why I was at a baby shower for, but that seems to be the new deal. So anyway, heard people talking about, oh, we're going to wait a couple years and we're going to have all these foreclosures. So we're going to talk about why that's most likely.
We're going to address that. We're going to address that today. Yeah,
so,
for sure.
Chris Madrid, Guaranteed Rate, best lender around. Let's talk about our current mortgage rates, trends, and then we will look at the real foreclosure data.
Man, this has been a wild couple days in the market, right? And again, we've said this before. We say it again. That's why we monitor and track on a daily basis, right? Because you have to know where the market's at, where it's headed, all that good stuff. And since Monday, things were on the upward swing. So mortgage-backed securities improved, mortgage rates came down, and then we had a quick reversal on Tuesday, Wednesday, which going to the chart here, I highlighted and circled to red, right? So if we're looking at the right side, that little area of red, that's not good. So if you're ever wondering, if you're looking at these little candlesticks here in whether you're looking at stocks or what have you, red candlesticks are not good, right? So I had a client that we were talking to. We're floating on Friday, floating their rate on Monday. And then as soon as we saw this little red candlestick expand there, I was like, hey, we definitely need to lock in. You're closing in less than 30 days. Let's go ahead and unless you like to gamble, let's go ahead and get you locked in. So we had a few that we got locked in. Obviously rates pushed up, and then we've seen them kind of settle back down, thankfully. So we haven't gone up as high. So we were pushing, at the peak of that, we were pushing 102, as you can see there to the right. And as of right now, we're sitting at about 101.5. So we've still got, have about 50 basis points to go, but rates are better, which is really good. I think for the first time in several weeks, we're below 5%, which is great. 4.75 on the low end, up to about 4.99, which is really good, really exciting for all you buyers out there. Again, we've talked about when rates are at 6%, versus a 5% rate, you qualify for 10% less, right? So now that rates have now dropped back down, there may be a chance to qualify or be able to afford a little bit more, because as we've been saying, right, affordability is what gets impacted when mortgage rates go up.
So when I look at this chart, if I go back to June 13th and looking at the red candle that's all the way down here at the 98%. Oof. What was interest rates on June 13th?
Yeah, so if you remember, I mean, that we were pushing 6.25%, 6.5% on a 30-year fixed conventional, right?
Okay.
So yeah, we've moved in the right direction. And again, going back, right? So we're going back to May, when we're looking at the little green candlesticks, right? We were still pretty close to, that 102, that 102 trend. So we're not there yet, right, at 101.5, but we're moving in the right direction. So
what were the rates on May, right around May 31st when we have
so that we were still in the mid fours, right? So back in May we were mid fours.
I just want to give our viewers a little idea of where interest rates are falling on this chart. So today we're at 4.75 and we're just under that 102 mark. So basically we can go back where that is at the 102, and that's when we're going to be in the mid fours. So if it ticks up 104, is that going to get us in the low fours?
That'll never happen. At least not. And here's the, obviously some of the things that let's talk about it. Let's talk about the data, right? So the Federal Reserve, when rates were, or mortgage-backed securities were trading in the 104s, they were purchasing mortgage-backed securities, right? So essentially they were filling their balance sheets with mortgage-backed securities, keeping mortgage rates artificially low. So they can't do that they just can't do that forever, right? So we talked about earlier this year, they started to unwind their balance sheet. They stopped purchasing mortgage-backed securities. And that's essentially where we've gone, we've gone from those 104 levels to, now below 102. So yeah, unless something catastrophic happens, and they need to help the economy along, yeah, I don't for a while. I think the 2% rates and maybe even 3% rates are a thing in the past for a little bit.
I mean, I think they say a healthy market interest rates are around 6, right? Is that
Right.
kind of, a healthy market? So
yeah,
we're right around in there. It's probably going to stay there, obviously, as Chris says, a while. The government, we've talked about this before, the government basically is controlling our economy based on the rate at which they lend their money. And we've shown you over the last couple of weeks that when the recession's period hits, which we believe we're starting to get into, if we're not, that then they will increase that and rates will come back down a little bit. But
and again, not to say that won't happen, right? What the Fed is doing right now and increasing the federal funds rate, they are wanting to slow the economy, which we've already started to see, right? One of the reports that came out today, initial jobless claims, which measures individual filings for unemployment benefits, for the first time has increased by 6,000 claims, right? So that total number is now 260,000 for the 4-week moving average. So if they go up like they're planning on it, I mean, they could slow that down the economy too much, right? Which they've done in the past. And then obviously there's a couple of things they can either start injecting money into the economy like we've seen in the past, or they'll bring the federal funds rate back down. I mean, there's a couple of things that they've already shown that they've done over the last 50, 60 years.
Okay. All right. So today, August 4th, 2022, interest rates right around 4.75, 4.99.
Yep.
Under 5, first time in a little bit. So anyway.